Welcome back everyone, Michael here with Offshore Citizen. Today I'm going to talk to you about a concept in banking called reserve requirements versus capital requirements. All right, what is the difference between the two? How do they matter, etc. So let's jump into it. Now this subject really has not a lot of practical application to somebody who is, I don't know, going to do business, right? Reserve requirements and capital requirements for banking don't matter. If you're investing in some sort of a financial institution, it may make a difference. And just in terms of understanding what's going on in the world, what's going on from a macroeconomic standpoint, etc., capital requirements versus reserve requirements is really important. And I was inspired to make this video based on the fact that I have a friend who's a financial advisor who contacted me the other day and he made some comment about, oh, you know, they've abolished the reserve requirements. And I was just like, who cares? Like, it does not matter, okay? Now, what the heck am I talking about when I say that? This comes down to something, if you go in, literally in some of the school textbooks, they teach something called fractional reserve banking. Fractional reserve banking has really no bearing on reality today in countries that issue their own currency. Okay, if you don't issue your own currency, totally different situation, but in cases where they do, no bearing whatsoever. And people confuse bank capital for bank reserves, okay? Back then, when I didn't know too much about this stuff, a friend and I sat down and we read the Banking Act and we went through what's called the Basel III regulations, which explain how banks are governed, etc., and kind of came to this realization of, oh shit, this is what goes on. And it really comes down to the fact that bank deposits have very little at all to do with bank lending. Okay, so the conventional narrative is, hey, how does banking work? People take money, they deposit it in the bank, then the bank turns around and they lend out a portion of that to customers, and they're able to lend out up to a maximum amount. They have to keep a certain reserve, right? And what you'll see if you hear the conversation about fractional reserve lending is that, okay, there's a 10% fractional reserve. I have no idea where the 10% comes from. It's total nonsense. It's not in the regulations. It's not how it works. But this is the story that gets taught, and so you have this what's called the money multiplier effect. Okay, so they take, let's say you start with, I don't know, $100,000, and you go and you're allowed to lend out 90% of it, so you lend out $90,000, but then that $90,000 gets deposited back into the bank, so then they can lend out 90% of that, which is $81,000, and then they can, that gets deposited back in the bank, and they can lend out $72,000, and so on and so forth. And if you add all this up, eventually, loan after loan after loan multiplies the overall size of this original $100,000 into $1 million. Okay, so 10% capital, reserve requirement translates to $1 million that can be lent out gradually over time. Now, in practice, nonsense, total nonsense, okay? Because of the fact that banks, first of all, don't need reserves in order to lend. So what are reserves? Let's start with that. Bank reserves is basically just cash sitting on the bank's balance sheet, okay? It's primarily derived from deposits, okay? Not necessarily, but primarily. You'll see if you go and look at the charts on what's happened to bank reserves, starting when they did quantitative easing in post-2008, 2009, you saw bank reserves just spiked. Why did that happen? Well, because basically the bonds on the bank balance sheets were purchased by the central bank, which swapped those bonds for bank reserves, and so the bank reserves went way up. And this did not stimulate lending, which was supposedly the idea. This makes tons of sense why it didn't stimulate lending, because of the fact I've done a video on this before, so you can go back and check that out. But bottom line is that banks are not reserves constrained, meaning that a bank does not need bank reserves in order to lend money, because they can always go and get money. We're talking about in countries like the US, Canada, Australia, UK, etc. They can always go to the overnight market and get money there to make up their reserve requirements, or they can borrow through what's called the discount window at the central bank. So this is total nonsense that they need that. You do not need, in order to make the loan out, they can basically just create the money, is the equivalent of what's happening there. Or rather, they're creating credit, okay? So, very simple. The idea historically, and there is a consequence of bank reserves, I'll get into it in a second, but historically, this was to prevent things like runs on banks. Okay, so when you actually had to go into the bank and pick out physical cash, having the cash there that people could withdraw and deposit, you needed a certain amount of that, right? Today, everything's electronic, or the vast majority of it is electronic, and so it doesn't particularly matter. This contrasts, though, with bank capital, and bank capital is really important, which let's go into what that is. So bank capital is essentially the bank's money, okay? So it's arguably primarily formed by shareholder capital and retained earnings, okay? So the bank has its own money, okay? And it has a requirement, and those requirements, loosely speaking, you're talking around 8%, although this is very, there's a formula in the bank regulations that depends on who it is that they're lending to, and then what the size of the bank is, and what the risks are, et cetera, type of the loan. And so if they're lending we'll say they're lending to a government, then they can lend an unlimited amount. So there's no capital, no limitation on bank capital because it doesn't affect it. If they're lending on very solid mortgages, then they can lend up, basically it becomes double, right? Basically the amount under the formula that the loan counts for is half of what's actually lent out, okay? And then as you get to lower and lower quality loans, it ends up being that they can lend less and less. And this is one of the reasons, by the way, that if you go back to 2008, when what they would do is they would package up loans and rate them AAA even though they weren't, that had a consequence for them in addition to, okay, what can we sell and so on and so forth. There was a consequence in terms of the regulations, right? If I say, hey, this is AAA rated mortgage, then my capital adequacy requirements under the regulations are lower than if this is, C grade, okay? So that's basically how it works. So let's see if I can kind of clarify for you what's going on here. If you wanted to open a bank, okay, you would need to put a certain amount of money into that bank, all right? The amount that you put in, this is not money that's owed to somebody. This is not deposits. This is not whatever. This is shareholder capital. This creates a limitation on how many loans that they can give, okay? They multiply bank capital, all right? So you have your bank, let's just say you had, $1 billion of capital, okay? Now, somebody comes to you and they want to borrow money. You don't need to be able to lend from that capital because you can go to assuming again that you're part of the banking system, et cetera, you can go to the overnight market and you can get, you can make up your reserve requirements. So that's not a problem. But you are limited how much you can lend based on these ratios of how much actual capital you need compared to how much loans you give, okay? Where is this important? This is important because of the fact that when you go and you make those loans could go bad, right? And so we're fundamentally concerned about with bank capital is, will the bank go bankrupt, all right? If the bank will go bankrupt, then that's a problem, right? So, and this is again why the capital requirements vary. So it's assumed that the central government is impeccably creditworthy. There's no chance the central government is going to go belly up. They're going to default. And as a result, the banks can lend an unlimited amount of money to them. Doesn't matter, I have my $1 billion, I could lend $1,000 trillion, $1 quadrillion to the central government. It will not affect my capital adequacy requirements, just not there. Because there's no perceived credit risk, right? If I then go to something that, I don't know, maybe it's a 20% down residential mortgage, I would have to double check the regulations, but probably that's going to count as a very solid mortgage that you're going to be able to say, okay, this is going to count 50-50. So I go and I can lend, for instance, again, I'm oversimplifying the formula. You can go and look it up if you're interested. I could lend out, say, let's say that my requirements are, I can lend out on that, I don't know, about 120 billion off my billion, okay? But actually, these are only going to count for 50%, so I can lend out about 250 billion in those types of mortgages, okay? And what's the reason for that? Well, the reason is the likelihood that they default and the likelihood that the bank loses money on that is very low, okay? Because they're more than covered. They've got this 20% margin of safety. Realistically, it's going to get paid down over time. It's diversified between a lot of loans, etc. And so, you're fairly safe, right? If on the other hand, you're like, okay, well, we're lending 95% loan to value, right? What's the chance that they default and the bank loses money now? Well, it's much higher. So now all of a sudden I'm only allowed to lend, let's say 100 billion, right? Again, I'm oversimplifying the formula, but just to illustrate the point. The concern is, hey, listen, if I'm lending 100 billion and I'm in a situation where and that's why my numbers would be way off. I'm off by an order of magnitude on these numbers, right? Because it would be more like 10 billion. But anyway, that being said, I lend out. How many of these need to default for the bank to be insolvent? Because what can happen if you study a bank failure is more or less you can end up with a couple different ways that they can fail. One is they cannot be profitable for a period of time. Okay, so banks that aren't profitable aren't good. So when we do analysis of bank financials, bank balance sheets, etc., to look for, is the money likely to be safe there, one of the key things we look at is the bank profitable? I want a bank that is long-term profitable, because profitable banks are more likely to be stable. The bank going bankrupt is bad if they're holding my money, okay? Even though technically my money is supposed to be ring-fenced and protected and all this kind of stuff, I'm a little bit concerned. But what could happen? I could be a profitable bank, and then something could happen, and for some reason, the assets could end up being worth less than I think. So my assets as a bank primarily weigh the loans that I make, right? And so people start defaulting, right? What happened in 2008, lots of adjustable rate mortgages, lots of trash mortgages, people start defaulting. Well, now that this asset that I thought was worth $1 million, it turns out is worth less because they default. And now I have to pay costs to go through foreclosure. I have to go through all the realtor fees, etc. Then it's a mass market collapse. So the prices that I'm going to be able to get for that property are going down a bunch, etc. So maybe my book is only worth half of what I think it's worth. Okay. So I need enough bank capital to absorb that loss. Okay. That's basically what's going on here. Now, where reserve requirements are relevant is if I'm in a situation where I need to go, I have customers who come to me and they want to take their money out, okay? So let's say, I don't know, I've got X amount of assets, I've got $10 billion in assets, and I have a small amount of reserves, let's say 100 million in reserves. And I have customers coming, there's a run on the bank, and they pull out more than 100 million in reserves. Well, now I have to somehow get access to more money to cover those withdrawals, right? Let's say they're pulling out 200 million. So I need it to cover a 100 million shortfall. Well, if that was the case, there's a risk that in order to do that, I have to sell long-term assets. And when I sell long-term assets very quickly, in a fire sale environment, I may take a loss on those, okay? So again, this is where the capital will cover it out. Now again, in practice, the way the system has been set up today, the central bank is likely just going to throw in the money. You can borrow it through the overnight market, the discount window. It's unlikely that a run on the bank, given the electronic nature of the financial system and all these kinds of things, is actually going to come out. But the important thing to note here is that because of all this, the amount of reserves, actual cash that's sitting there, has comparatively nothing to do with whether the bank is going to go bankrupt. Comparatively nothing. And the idea that they're constrained by this, and that this is a problem, is not relevant when you consider it in the context of bank capital. Right? The bank capital is there to protect you anyway. That's the thing that's really going to keep the bank solvent. This other thing is just to take advantage of the short-term cash requirements. And if you add on to that the fact that the short-term cash requirements can be covered through the central bank, can be covered through the overnight market, etc., it's really irrelevant. And so what you're seeing in general across the world today is that reserve requirements have dropped to, very, very low, in some cases zero. And in practice, banks do keep some amount around, and so the practical application of it is a little bit different. But the reserves are not an issue. The capital is an issue, and capital requirements tightened post 2008, 2009 when they went from Basel II to Basel III regulations. And so, today they're much more acutely aware of that in the wake of all these banks that failed in the kind of post 2008 financial crisis. Okay. So anyway, I hope that helps. I hope that explains it. Like this video if you have questions, if you think I'm off base, etc. Write so in the comments. Go and subscribe to our channel. I've got a bunch of videos on kind of some of this macroeconomic investing type stuff. You can go and check those out, as well as tax advice, information about or not tax advice per se, but tax information about how taxes work, how asset protection works, how different corporate forms work, banking, etc., investing. So go and check that out. And if you have any interest in contacting us, we're happy to help you, navigate your own needs. So you can visit our websites, offshorecitizen.net, offshorecapitalist.com. and you book a call, and I will see you guys on the next video.